Hi, this is James Eng with Full Capital, and this August 2024 multifamily financing webinar, I'm titling A New Cycle. And so, when we're going through this decline in pricing the last couple of years, it is been pretty difficult. And so, when somebody as large as Blackstone on their quarterly call basically comes out and says, "Look, now that the cost of capital is coming down, so whether that's treasuries or SOFR, um, they believe this is a basis for a new cycle of increasing values in real estate, and they're putting their money where their mouth is, and they have put a lot of money down in the last 2 quarters of this year, the first 2 quarters of this year, and so they see increasing values in real estate, but at the same time, new construction coming down pretty dramatically, especially in sort of their two buckets, which is multifamily and industrial that Blackstone's been playing in. So I thought that was super applicable in terms of calling this a new cycle. And so in this webinar, I'm going to be covering the reports. So Newmark just put out a good report, CBRE as well, and then really reviewing the earnings reports of equity owners. So, guys who are investors, REITs, large REITs that own, hundreds of thousands of units. Then we'll look at what the brokers are seeing and then also what lenders are seeing, and then talk about how deals are getting financed in today's market. All right. So this comes out of Newmark, and, until you look at the supply and the amount of supply on a chart, like you can't believe it. Every quarter, new records of supply are being broken. So if you go back to like 15, 16, 17, like the trend is, let's say 80,000 a quarter across the nation. And then you see sort of beginning of this year, it hit 120. Now you're up to 160. And then Q3 and Q4, you're going to be, 170, 180. So if you add that up, I mean, let's say your typical year, you might have 300,000, 350,000 deliveries. In 2024, they're going to be delivering, let's try to do the math here, like 5 to 600,000. So 2x the number of deliveries that you would in a normal year from the last, 7 or 8 years. And so that is definitely impacting everything, and you'll see it throughout these reports. Supply is impacting everybody, whether it's A, B, or C. And then, what you can't see here is the forecasted deliveries. The flip side of this is, all right, how many deals are getting started in 2024 and thus delivering in 2025, 26, 27? Because in 21, 22, 23, sorry, 21 and 22, this is when all these deliveries started. So that's what's hitting right now. And then if you look at, all right, well, the supply is really high. Is there enough demand? And so, we had a little bit of a dip in demand, sort of 22 and beginning of 23, in that time frame. But then in the first, last 3 or 4 quarters here, demand has come back, and people are asking, so why is demand so strong right now on the apartment side? And it's really driven by, interest rates hurt commercial real estate values, but then it also makes it more expensive to get into a house. And so if you compare the spread between, all right, buying a house versus renting, this gap, which we've talked about before, is at an all-time high. So, average rent's about 1,800, and then the median monthly payment is about $1,100 higher, or close to 2,900. And so that demand that we saw in this previous chart that is coming from multifamily, a lot of that is driven by just, what's your other option? So people are staying in multifamily properties longer, and then before moving into a home, just because the cost is so much higher and that gap is so much higher. So that's absorbing a lot of the supply that we saw on this first chart, is that there's a ton of supply, but then the demand is there right behind it. So that is helping. And if we were down here, you would see concessions a lot higher than they are right now. All right, so that's the demand side. Um, it's still hard to push rents right now. And it all starts back with that supply piece. And so you're seeing rents probably for the last year just be around 1% plus or minus. And so you're seeing a little bit of positive rent growth, but it's probably going to be, depending on the submarket, depending on the market, you probably still have another 12 months of rents essentially being flat because all the supply has to get through the system. And as new supply gives, 2 months free, then your B stuff has to give a month free. And then your C stuff has even got to give, $500 to $1,000 off the first month. And so where are you seeing, this is across the nation, the 1%, but then in the heavy supply markets, like Houston, Dallas, Austin, you're seeing negative rent growth year over year. And so Dallas, you're probably around -3, and then Austin is all the way down at -7 in terms of rent growth, just because of the amount of supply that are coming on. And then so, everybody's like, well, if I don't have to transact as a seller, I probably don't want to transact right now in today's market because cap rates have come up. And it's been challenging for buyers to find anything that gets you positive leverage. And so if you look at this chart, this is probably the best chart. The gray line is really your average cap rate. And then your blue line is really your average interest rate. And so there's been a healthy, 150 basis point on average gap between your cap rate and your interest rate. And then when the Fed sort of moved their rates up, starting sort of second half of 22, that sort of crossed over to the point where the last 2 years, so second quarter of 22, it's all the way till now, those two have been very tight. And so you're not getting that typical 150 basis point spread that you would want to compensate you for the risk that you're taking on these deals. And so this is what's really driving the limited transaction activity that we've seen in the market. In terms of overall originations, I mean, you have to go back to 2015, so almost 10 years ago, where you saw similar volumes in terms of loan originations. And I mean, this is probably, a lot of these 21 and 22, that was almost all acquisition volume. Right now, you're probably seeing half and half acquisition and refinances in terms of originations right now. And then, this is what everybody was seeing probably in 22 and 23 is that, look, all these deals are going to mature, and they are going to mature. The challenge is that a lot of these, whether it's debt funds, a lot of these deals had 3-year initial terms and then +2 1-year extensions. And so what you're seeing is that everything that's sort of in this 24 column, the 275 billion here, a lot of the stuff in the debt fund or in the securitizations, a lot of the stuff is just moving over to 2025. So we're not seeing a lot of these deals get foreclosed. A lot of these deals are getting extended and modified in order to, the lender really doesn't want to take back the property, and the borrower can't refinance into an agency loan right now. And so they're having to move and extend these deals over. And so these maturities keep moving. So this wall of maturities, I guess, at some point will hit, but with rates coming down, everyone's hoping that they can either refinance or sell these assets before the foreclosure comes. And so, we've seen a little bit of a pickup in the second quarter, from really just large transactions, whether it's Blackstone, KKR, Equity Residential, these guys are buying, 5,000 units, 10,000 units, like on a portfolio basis. So very large portfolios are trading. And some of these guys, there's always a reason, but they've raised so much capital and they've got to get the money out at some point. And so the last 2 years, like we saw on this chart, last 2 years, it's been hard to really pencil a deal. And so a lot of these guys have just been buying deals all cash, and at some point they will either refinance those properties or use some sort of line of credit that maybe is at a lower interest rate than Fannie and Freddie. And so if you look at, all right, so institutional money was sort of, let's see, let's see if they have an institute. Well, they don't have institution on here, but show this entity level. And so that's picked up significantly in 2024. They mentioned a couple here, whether it's Blackstone taking Air Communities private, KKR buying a $2 billion acquisition in Brookfield, buying a deal from Starwood. Like these are large portfolios that in 22 and well, let's say back half of 22 and all of 23, completely silent on the institutional side. And so now for these guys to be stepping into the market, it's a huge vote of confidence that pricing has reset and these guys are willing to go right now. And so I thought this was an interesting chart on we're always trying to predict the future and trying to figure out, is now the time to, lock the rate? Is now the time to float? And, what does the economics tell us of what's going to happen? So they put some percentages here. So we'll sort of start with the soft landing. So they have soft landing at 55%. And so that has treasuries essentially where they are now, 3.5 to 4.2. Fed funds about 3%, and then credit spreads about returning to average. So your all-in rate is probably around 5% plus or minus, 25 basis points or 50 basis points. So you might be down to 450, you might be down to 5 or up to 550. So that rate they sort of have baked in as a soft landing. The second thing that if it's a hard landing, like basically similar to the payroll number that came out, they have to cut rates very aggressively. They have the Fed funds going down to zero in December 2025, which would dramatically change the entire market. 10-year treasury would drop, and then credit spreads would be higher. So your all-in rate would probably be closer to probably in low fours, just depending on how high the credit spreads would go. So they have that as a second. These two up here, long-term federal funds at 4 or greater, or 3.5 to 4. This is sort of what we've been living the last probably 18 months, is that there really hasn't been any landing. Inflation's just been hanging around. And so they put these at 10 and 5%. So they have these at low probability. So prepare for this soft landing piece or the hard landing piece is what their probabilities are. All right, so that was Newmark's interpretation of the market right now and what they're seeing. CBRE puts out a cap rate survey every quarter, I believe, and so I just pulled out one slide of sort of the Texas markets and sort of where they're seeing Class A trade, and you see Austin at 4.5 to 525, Dallas at 475 to 5.5, so a little, maybe 25 basis points higher. Houston is 100 basis points higher, so they're close to 625, 675, and then San Antonio, similar to Dallas, 475 to 5.5. But the trend that they're seeing across nationally is that this expansion. So if you go back and look at their other charts, they probably dipped into like the low fours, high threes cap rates, and then they have expanded all the way up to 5%, and then across the nation. And now they're thinking, I think they've had like 1 or 2 quarters of sort of stabilizing cap rates, and so they think that the expansion has peaked. So they're thinking the cap rates aren't going to expand from here. All right, so this is one of the deals that just happened. Equity Residential buying $1 billion portfolio from Blackstone. So 11 apartments. So this came out to about $270 a door, and these properties were in Atlanta, DFW, and Denver. And so when you listen to Equity Residential's call, they hadn't announced that deal yet, I don't believe, but they really don't. Most of their, I hadn't really followed them much, but they pretty much have like a very coastal portfolio. And so they're going into really these four cities that they're calling their expansion markets: Atlanta, Austin, DFW, and Denver. And right now it's only 6% of their NOI. But, their push into these markets with that portfolio buy, and they're going to buy more there. From what they're seeing is that they basically underwrote a 5% cap rate, and they understand that, rents are going to be down for maybe a year, but they're going to come back once supply slows down. And they're seeing the same demand piece that we were seeing previous, which high home ownership, limited for sale, and sort of a steady employment picture. And so, for the next, whether it's new leases or even retention, it's been challenging with the new supply in these markets. But, they think it's gonna come out the other side a lot better. And then this is impacting their retention, right? So they're sort of mid 40s on the retention ratio of their residents versus, in some of their established coastal markets closer to 55 to 60. And they're going to focus really on buying from developers who have bank debt and think that it's going to sell, not necessarily at sort of fire sale prices, but a good basis that they would want to be in, so lower than replacement costs. Let's see. All right, so the next REIT that on the equity side is Camden, and their perspective on the market right now is that everybody's waiting. Uh, you know, Operations are waiting for the peak cycle apartments to come through. Everyone's waiting on the Fed, and buyers and sellers are waiting for each other to give in a little bit. And so everybody's waiting from Camden's side. And so, um, they're seeing a lot of deliveries. They are definitely more of a Sunbelt REIT, and so they are, they're getting hit with a lot of supply right now. But they are starting, if you look in the green at the bottom, they're starting, some very expensive, $150 million, you know, new construction deals in Charlotte, and these are coming in at, 350 to 400 a unit. And, I think in order to start a new construction deal right now, you sort of already had the land ready. You already had to have all your stuff ready to go. And these guys think it's going to be a lot better environment to deliver into, which is 26 and 27. But I think it's still hard for just your normal private developer to get a deal to pencil, going to get a recourse bank loan and, having an exit and making it work right now. So not a lot of people are developing from that perspective. But what you're going to see across these REITs is that they're slowly dipping their toe back into development. All right, in terms of operations, new leases, they were, down about 2%. Renewals are up about 4, and their occupancy was about 95%. And then the other comment they had was on insurance. Insurance has been up, it was up 40% last year. They thought it was going to be up more, and they think it's going to be about flat this year. So some cooling down on the insurance side. All right, so MAA, similar Sunbelt, more. So Camden is more of your, I would say A minus. Similar, MAA has some B and A stuff, Class A and B, and they're dealing with the same new supply because they're in the same markets. But they also are starting some new construction. They've got 2,600 units going at 866 million. So a little bit lower price per door than Camden. And, they're seeing caps in the 5% range. So their new leases, a little bit more challenging, negative 5.1, renewals at 4.6. So net, if you're renewing about 50% of your units, hopefully you're maybe a little bit negative, but pretty much neutral on your rental growth. And then, they were asked about free rent concessions, and, anywhere from half a month to a month is what they're seeing in their markets. And then, the larger submarkets with a lot of new supply, like downtown Austin, closer to 2 months. My sister just signed a lease in Austin with 2 months free on a lease up deal that was I think she said it was like 45% occupied today. So definitely 2 months is out there in the Austin submarket. Um, and then, they talked about insurance as well. And then, cap rates, I, I feel like everybody was pretty on, in unison about 5% just sort of being the number. And, when that seems to be the number that sellers are willing to transact at. And at the same time, you can get very, very close to that um, in terms of your interest rate. And so, this last comment around people are willing to accept that negative leverage because they see a little bit of hole of the supply in 26 and 27. And with that hole in supply, they're thinking that rent growth, as long as demand is there and the economy doesn't fall off completely, there's going to be rental growth demand there. All right, so that was sort of more on the equity side of the REIT side, public REIT side, on the multifamily side. Blackstone is a huge player in the real estate space, but they don't just do real estate, so it's nice to hear what they're saying. Um, in the second quarter, they deployed 34 billion, which is the highest they've done in the last 2 years. So that's sort of like your first signal. They think, inflation's going down, Fed's going to start cutting. And and this is, I thought, was a good motto for anybody out there is, all right, right assets. All right. So that's, whether it's the location, the age of the property, the right sectors. So their focus is really multifamily, industrial, and data centers, and then right capital. So those three things, like if you can do those three things correctly, you can survive these downturns, right? So if you have the right asset and the right location, you're in a sector that's growing and that's a need for consumers, and then the right capital structure. So this third thing is what really has thrown people off in 21 and 22 is having the right capital structure. And that's forcing some foreclosures and some sales right now. But this was an amazing stat. So in 2007, 2% of their portfolio was warehouses, rental housing, and data centers. 2%. And currently, those three components or three sectors make up 75%. So it went from 2% to 75%. So they basically sold a bunch of US office buildings and bought warehouses, rental housing, and data centers. So they believe this is a new cycle of increasing values in real estate, and they've already deployed 15 billion in the first 6 months of this year. And they looked at Green Street. So Green Street, in terms of private real estate values, have essentially been flat the entire year so far. They're seeing more bidders show up. So they just sold a portfolio to Equity Residential. So they're seeing more bidders show up. And they understand that, the sentiment's going to be negative for a little bit just because of you've had a year or 2 years of values going down. And it was the same thing during the financial crisis, like 2008. Nobody was jumping in. 2009, very rarely did people jump in, right? So they talked about, they started deploying in the summer of 2009, and there were still negative headlines in 10, 11, 12. But you've got to be able to sort of sustain past and through that. And they still think the sentiment's negative, but they're starting to see that people are recognizing that the pricing has reset, and they feel like, they raise billions of dollars every quarter, and so they got to put some money to work, and they feel like this is a good time. Um, KKR, they just bought a $2 billion portfolio of 5,000 units. Their yield going in was a 4, so pretty expensive, low 4 range, but they are betting on appreciation of this asset. So KKR is getting into the multifamily game, and not as big as Blackstone, but on the way up. And then, I also wanted to look at some of the sort of providers of commercial real estate. And so I went through CoStar's report, and I thought it was pretty interesting because they were like, look, this is actually a pretty favorable advertising environment. They called it Goldilocks zone because when vacancy rates are too high, so vacancy right now is, let's say they have it at 9%, so 91% occupied. When you're in that zone, people advertise because you need to get up to 95. But then if your vacancy goes uh, too high, right? So think office, right? Like if you don't have money to pay your real estate taxes or insurance, then you don't have money for advertising. So you don't have the liquidity to pay for ads. And then also, if all your buildings are full, like probably let's think back to 2021, your occupancy is 97% and you got a waiting list of 50 people. Do you need to advertise? No. Right. So CoStar actually provided a pretty good uh, analysis of why they think apartments.com is still a viable thing in today's environment, because it's not too high but not too low, and so it works just right for them. Marcus and Millichap, they had a challenging quarter for the second quarter, and the thing I'm going to highlight here is really just that bid-ask spread between buyers and sellers, and there just hasn't been like, yes, I understand Blackstone thinks pricing has reset, but the challenge is unless you have to sell, nobody's coming to market with anything unless they have to sell. And so have to sell means, you have a bridge loan coming due and you can't extend because the lender won't let you, or you have a pay down, or you have an interest rate cap that you have to come up with money for. And so let's go. So we started with equity, looked at brokers, and now let's go into the lender side. So Arbor did a lot of bridge loans in sort of 21 and 22, and they called, the first two quarters of this year very challenging. And they think, third and fourth quarter, rates have slowly come down. And so I think they're expecting more stress in the third and fourth quarter of this year. They modified $730 million of loans. Most of those probably bridge loans. And this is sort of how they structured it, right? So they had them buy new interest rate caps. They had them fund interest reserves, catch up the interest, pay down the loan. And then, on about, I guess, 400 million of the 730, they provided some rate relief. So they said, look, your current deal is SOFR plus 3, so that's 8% or 8.33%. We're going to give you, we're going to bring that down, and you pay us maybe 6.5 or 7% current. And so right now they have 7% on average and then 2% on the residual. So they're accruing that interest that you would pay at the end. And they have $1 billion of loans that are past due right now, so they're modifying them. And then this is what they expected. And they're having to work through these deals. And of the billion, an analyst asked, how's that stuff going to get worked out? And they said 30% they're just going to have to take back, foreclose on. 10 to 15% they're going to bring in a new sponsor. And then the other 40% they're expecting just to be sold, right? So as rates come down, give these guys enough time to sell the deal to at least pay off the loan. These rates are definitely helping them as they drop. And then they're expecting that as rates drop, there's going to be more liquidity into multifamily. And then they see the light at the end of the tunnel. So the last 2 years have probably been the tunnel, and now they're seeing a little bit of light now. And so they think this is sort of the bottom on the credit fundamentals. They modified a significant amount of loans. Okay, so this is actually this was Arbor. So they had about $1 billion that or they modified 730 million, and then about $1 billion that they're going to still have to sort of restructure. Ready Capital was also in the bridge loan space. And so for the second quarter, they reported that they had to modify 800 million in loans. The current metrics on those deals were about 5% debt yield. They gave them an extension of 12 months, and then they reduced their spread. And so if you look at this, the debt yield to get into like a Fannie or Freddie loan today probably needs to be closer to 8%. And so these current loans just can't get there. So they're having to extend these and extend these loans. And then this was probably the bigger thing is that Ready Capital is starting to sell their loans. So they don't think that they can collect the full balance. And so they're starting to sell some of these loans at a loss. And so we had not seen that from other lenders. Ready Capital was sort of one of the first ones, but besides the bank up in New York who had sold some sort of affordable deals, like Ready Capital is definitely more into, I feel like the market rent space of multifamily, so market rate multifamily, and they're starting to sell. So what's hard is they don't really give a lot of detail on which of their loans they're selling, but they were selling it at a loss. All right, and then Walker and Dunlop is the last lender, and they did not do bridge loans. They were focused more on Fannie and Freddie, and their sentiment is, look, there's been 2 years of rising rates, limited investment activity, and it's time to get active again. And 10-year below 4 is sort of like the break point for a lot of people. And so the last 2 years, they called the Great Tightening, and I hadn't heard that anywhere, so I thought that was interesting. And in terms of they need these lower rates to really pick up the transaction activity. And this was interesting, sort of during COVID. 45% of the loans were 10-year loans for Fannie Mae, 0% 5-year. And then the first 6 months of 2024, 10-year loans dropped to just a quarter, 26%. And then the volume for 5-year loans grew to 32%. So people feel like this is the sort of the peak interest rate time. So they're taking shorter term loans so that they don't have a big yield maintenance penalty, and they can refi or sell the asset earlier. All right. So in terms of where the Fed's going to focus now, Pensford puts out some good newsletters, and I clipped this from one of their newsletters, and it's sort of like a seesaw. Like the Fed's dual mandate is really around. All right, if unemployment is low and inflation is high, you need to focus on inflation. So that's what they did. They raised interest rates, inflation got beaten down, and we're hoping stays below 3%. But now in 2025, is unemployment going to fly up now that, like, have we this seesaw, have we gone too far the other way? And so the Fed's focus is definitely more on unemployment now versus inflation. The forecast is sort of for 25 basis point cuts. The market's expecting sort of in the next, let's say, 3 meetings. So September, November, December, they're expecting 3 cuts to put us around 450 to 475, and then another 3 or 4 cuts by the end of 25, being at like 325. And so, I mean, this is going to do a ton of good for people who are on floaters, people who are having to do interest rate caps. Um, this is going to save them a lot of money on the interest rate side. And the real thing is, like, how much does it move the 10-year treasury? Because 10-year treasury right now started a year probably closer to like December, January, you were under 4, and then the whole year has just been creeping back up and sort of got up to 4.7 this year, and now we're pretty much back down to the lowest point it's been all year. And so if federal funds comes down to, let's say, 450 at the end of the year, and then 325 at the end of December of 25, then does 10-year treasury stick here? Because this is what you're really basing Fannie and Freddie loans off of. So my background, if you didn't know and you made it this far, born and raised in Houston, went to school in Austin at UT, and I've been up here in DFW since 2006. I was an underwriter for GE Capital doing their balance sheet CMBS loans, and then in 2015 moved over and started originating multifamily loans at Old Capital for the last since 2015, and then invested in pretty much all the markets here in Texas, the major markets here in Texas. All right. So in terms of financing, what people are doing right now, whether it's bank loans, Freddie, Fannie, non-recourse bridge, we'll sort of go through these. So on the bank loan side, I mean, banks are definitely still active, but they are more particular They definitely want you to bring deposits. So those deposits could be anywhere from 10 to 20% of the loan amount. They can definitely get deals done faster than agency. We're doing a lot of these sort of 5 million and under is where we're seeing those still work. And, bank loans can work on multifamily, it can work on industrial, office, self-storage, all those property types. All right, Freddie Mac SBL. So this has been they've been updating their rates a lot. I mean, now they're sort of 5.5 to 6 right now. This is 1 to about 7.5 million and non-recourse. And so this was the loan that we did in Dallas, sort of stabilized. It needs to be stabilized, and then it has to have a good amount of income statement financials. So historical documents. Sometimes on these smaller deals, if it's run self-managed by a mom and pop, it is sometimes challenging to get Freddie Mac SBL. So you have to go with a bank loan first and then move it over to Freddie Mac SBL once you have good 12, 24 months of history. Freddie Mac conventional, these guys did a lot of floating rate loans, so we're moving a lot of those to fixed rate just to get people off escrows and purchasing new caps. And these, and in Freddie, the other thing probably is around they are a little bit more lenient on the preferred equity. So if let's say there's a gap, like you have a bridge loan of 20 million, Freddie's coming in at 18, and then instead of the $2 million that you would have to go back to your investors to rate or just do a capital call, Freddie Mac allows you to use preferred equity, and that person can come in up to a certain amount just based off your debt service coverage. And instead of you going out and raising money, you can use that preferred equity with Freddie Mac. And then on the Fannie Mae side, very similar to Freddie Mac, these guys have been focused on affordability. So the spread that you get will be dependent on really the affordability of the deal. So the better affordability, the better spread that you would get on Fannie Mae. And then non-recourse bridge. So, obviously there's less bridge lenders out there right now, but definitely it's still what we're seeing is a lot of bridge lenders sort of reworking their old deals into bringing in new sponsorship, like Arbor talked about. Their spreads anywhere from SOFR +3 all the way up to SOFR +4. And these interest rates have come down, right? So you can sort of hedge your risk, and you could buy a 3-year cap, let's say at 2%, and then sort of buy that at closing. You're sort of set for the next 3 to 4 years. Here's some of the closings that we've had just in the last year or so. Mostly Fannie and Freddie is where majority of our financings have gone just in the last, let's say, 12 months. And then, so, whether you're using Bridge, Fannie, Freddie, HUD, we're sort of here to walk you through the process on all these different product types and sort of educate you and help you through the process, whether you're a buyer or, refinancing your deal. And then our big event this year is coming up October 9th and 10th. This year we're hosting at the George Bush Presidential Center, which is real close to the SMU. So if you have not signed up for that event, go to oldcapitalconference.com and you can get tickets for that event. And then definitely subscribe to the channel, like, comment on this video if you found value in it. In terms of helping you with your next loan maturity, loan term sheet, or just reviewing a deal, feel free to send me an email with that information, and I'd be happy to go through it with you. All right, see you guys on the next webinar.